Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. This week we see the latest US core PCE price index data coming out of the US. Of course, everyone's growing very confident around the idea that we're going to see rate cuts in the coming meetings from the Federal Reserve. But will this inflation report undermine that? What's going to be the impact of this report on the likes of the US dollar, gold, and the Nasdaq? Let's get into that and more in today's video. So first and foremost, let's jump into the expectations. And this is what's currently being priced in by markets. According to Trading Economics, the core figures generally are the more important ones. This is the key metric that's being followed by the Federal Reserve, their favored inflation metric. And the expectation is that on a monthly basis, we're actually going to drop down to 0.2%. That is the key takeaway. As long as that happens, for me, that means that once again, we've seen the signal that inflation is not a problem and that we're going to see the Federal Reserve have a more dovish outlook. Remember, we've come off the back of an appearance from Powell at the Jackson Hole Symposium. We've seen their FOMC minutes. The minutes, by and large, were pointing towards them caring more about the unemployment picture, caring more about and worrying more about the inflation picture than the unemployment picture, but it was relatively lagging in nature, so they hadn't seen some of the more recent data. This time around, we're looking at inflation and saying, okay, they've essentially laid out a pathway, and Jay Powell has at the Jackson Hole Symposium laid out a pathway for a rate cut in September and a looser stance going forward. Now, it's certainly not a given that we're going to see a rate cut at every remaining meeting this year. Certainly, as things start to shift, we have the data coming out weak on the jobs front, inflation by and large under control, and then we have a shifting narrative around the Federal Reserve. Of course, Jerome Powell has already replaced Kugler. He's trying his best to push out Donald Trump is trying to do his best to push out Powell. And then thirdly, now we're seeing that he's trying to push out Lisa Cook. So he's doing everything he can to try and replace as many members of the Federal Reserve as possible, undermine their independence to a large extent, but really trying to replace people to try and get as many doves into the FOMC. So all in all here, 0.2 expected on that headline core PCE figure for the month, and then the annual figure 2.8% remaining steady as a result. Now, key to this will be the outlook for the Federal Reserve, and the Federal Reserve has two main areas to worry about. First and foremost, it's inflation, as highlighted by this core PCE price index figure, like I said, 2.8%, but also unemployment. So if we see an unemployment rate rise, then that again is something that could spur them to act. At the moment, we're not necessarily seeing it. Of course, we're seeing weakness in terms of the payrolls numbers. We're not seeing a big spike in terms of the unemployment rate, but certainly something to keep an eye out on. So it's just worthwhile bearing in mind that you have to sort of counterbalance the two here. Now, key amongst the sort of major concerns recently has been the payroll numbers, that we saw a weak figure last time around, but we also saw massive revisions to the prior 2 months. Now, in actual fact, those downward revisions have been growing over the course of the past, say, 6 months. The past two, particularly notable, really tallied up to a significant amount, 258,000 jobs in just 2 months worth of revisions alone. As you can see here, by and large, over the past couple of years, most of the revisions have actually been towards the downside. So it's almost like if you see a bad number, be aware it could actually get worse once the revision comes out. But this provides the basis for the Federal Reserve to think, okay, we were data dependent and the data has changed. It turns out the data we were looking at and making our decisions wasn't actually the correct data. Now that we've got the full sample, or the full subset, you're essentially now looking at a different picture. So it pushes the Fed in a direction of taking greater action. But the flip side of it is they have the dual mandate. You have the unemployment side of things, or payrolls, or whatever, the jobs market, and then you have the inflation picture. And so this week's core PCE figure, if we see a sharp spike in terms of that, we're likely to rapidly unwind those expectations for rate cuts over the near term, because suddenly we think we're in for a sharp rise in terms of inflation. Now, bear in mind, we've also just this week been hearing that Donald Trump is talking about 200% tariffs on China if they don't send rare earth magnets over to the US. They're talking about raising tariffs on countries that don't that currently implement the digital services tax, so the European countries in particular coming into play there. So there could be further tariffs down the line. Certainly it could be worse to come. But as things stand, how are they impacting prices in the US? If we don't see that uptick in terms of inflation, as is currently being forecast, then it provides the basis for the Federal Reserve to remain relatively dovish in nature. Here is the breakdown between headline CPI and then core PCE. And what we can see here is that by and large, that CPI number was under control. You can see that the figure in terms of the CPI relatively under control. I mean, it's gradually gaining a bit of ground, but last month it ticked a little bit higher. The PCE figure is flatlining to a greater degree over an extended period of time. It's really been sort of stuck in the middle of the twos for quite a while now. Whether we're going to see that sort of gather momentum and start to push higher remains to be seen. But if we're looking at things from a sort of base effect standpoint, as we always do, look back to the last July, and it's at 0.2, right? That orange bar on the left. The fact that it's at 0.2 and we're expecting 0.2 this time, that's why we're expecting that figure to remain at 2.8%. If we look forward, when's the disinflation going to kick in? Well, in terms of the months where we see elevated core PCE, you can see September and October, a little bit elevated, more towards the 0.3, nothing massive though. Really, the big numbers come at the beginning of the year. So January and February is where we saw those very strong core PCE figures. So we could see some disinflation coming into play then. Other than that, there's a good chance that we're sort of stuck within the middle to high twos for a while on the PCE figures. That's not necessarily the end of the world, and the Fed can likely deal with that, but they just won't want to see a significant uptick in terms of inflation pressures. And that's why that monthly figure is really important, because the annual figure wraps up the last 12 months, but they need to know what's happening right now. Are we seeing tariffs feeding through into what consumers are paying? And that's why the monthly figure, if it stays at 0.2, provides the basis for the Federal Reserve to remain relatively accommodative in terms of nature. Now, when we look at inflation, we've got the CPI, we've got the core PCE, and we've got the PPI. The PPI figure more recently rising both the headline and the core numbers up to 0.9%. And so the question mark is how much of this is related to tariffs. We don't necessarily know, and some of the different metrics that don't even look like they're related to tariffs might still be a business that actually has got those tariffs coming into play, and therefore it's sort of pushing prices higher in one way or another. But you can see here it is a break from the norm. That 0.9 figure really does stand out. So it's a bit of a warning sign that we might see a spike in terms of inflation and the core PCE. They're two very different metrics, but nonetheless, it's something that markets definitely paid attention to at the sign, and we thought could be a warning sign. The caveat here is if you look at the prior 2 months, they were both negative. 2 out of the prior 3 were negative. So you can see that, if you start averaging it out, it doesn't necessarily look as bad. ISM numbers are one area that I look at. The ISM services and the ISM manufacturing PMI figures, they're notable because they have subsections attributed to different things like new orders. And crucially, we have here the prices paid element. And so within the services sector, how are these purchasing managers seeing prices coming through within manufacturing and within services? And what we can see here is we did see a surge in terms of the sort of prices paid element, but it's starting to roll over a little bit on the manufacturing side, not so much on the services side. I've provided a 6-month lag between that and the core PCE figure. The core PCE numbers, whether you're looking at the sort of wider annual metric or drilling it down into the shorter term by going into, say, the 6-month or going into the 3-month annualized, none of them have really seen a significant uptick. So are we going to start to see it this time around, or do we just remain under control? If we see inflation remaining under control, of course, that provides the basis for us to expect to see rates coming down. So what's the relationship between interest rate expectations and markets, right? Different markets. So this is expectations overlaid with the likes of the US dollar index. As we can see here, by and large, we've been seeing expectations of where rates will be by that December meeting sort of coming down. You can see to a large extent, although they're not perfectly paired up, we've also seen the likes of the US dollar losing traction, but that's been a relatively protracted move. Now, in terms of the chart itself, let's just jump onto that. And what we can see here is that in actual fact, prices look like they're rolling over from fib resistance here. So this is the sort of wider context. The daily time frame shows you that sell-off's really been a 2025 story thus far. We've now gone into this phase where you're sort of questioning whether we're bottoming out here, or we're just in sideways consolidation. Certainly there's a lack of confidence in the directional bias as things stand. But like I said, we've seen this sort of breakdown. So if we're looking at it in terms of this move here, we're sort of seeing this creation of lower highs. And this rally then points towards potential for another lower high and a breakdown below 97.555. Well, we've rallied and touched that 76.4 fib on 2 occasions and starting to weaken here. If we see it over, say, the 15-minute chart, we can see here that sort of latest high just about creating a new one, but really it's almost like a flatlining high there, kind of like a lopsided double top formation. Certainly greater confidence sort of builds when you get a break through that 98.1 level. If we break that, then it could point towards the bears really back in charge here for a chart that over the wider context you can see is bearish in nature. So if we see inflation coming in as markets are expecting, say 0.2 on the monthly, then it's likely that we're going to see the sort of bearish theme playing out once again for the likes of the US dollar. Of course, the flip side is if we see strong inflation data, we could start to see those rate cut expectations roll back, driving upside for the greenback. Next up, let's look at the relationship between expectations for year-end rates versus the likes of gold. Now, I have inverted this. Yeah, I've named it. Yeah, okay. So I've inverted gold. Gold has been going up. But if you look at price action in gold, which is the pink line, over the course of the past, say, 4 months, 5 months, it's really not been going anywhere. It's been largely range-bound in nature. But if you see, the beginning of that range-bound phase was the period where we started to see expectations for year-end rates rise amid inflation concerns. That, by and large, was around the time that Donald Trump came into power. And so what you can say is that, like, whilst we've now started to see those rate expectations drop, by and large, we're still within this sort of range-bound phase because we're back to sort of where we were back in sort of early April, really, when it comes to rate expectations. So there has been sort of largely flatlining price action in terms of gold, waiting for that turnaround. It's almost as if markets are thinking, well, we know that soon enough we're going to get the rate cut. We're willing to go horizontal rather than see a major pullback in terms of gold as we wait for the data to turn in a meaningful manner. And so that's what appears to be happening. So if we see this coming out and it's informing us that we are going to see a raft of rate cuts over the near term, that could potentially provide the bullish breakout for gold. Let's see in terms of the chart itself, jump onto it here. So what we can see here is that essentially, there we go. Essentially, we're trading within the symmetrical triangle formation. Now, from a wider perspective, it looks like this, right? So essentially, given that wider bullish trend, this current symmetrical triangle formation looks like a continuation pattern. But like I said, we've been largely treading water. If you look at sort of horizontal levels here, we'll be looking at sort of there to roughly there, right? So sort of 32.48 up to 34.35. So more recently narrowing a bit, but ultimately we still remain within this range. And so we really need to break through 34.35 to point towards a potential exit from this consolidation phase that's been dominating for a while. And in terms of the data, it's the likes of a weak inflation metric that would potentially drive that upside move for gold as we start to factor in additional rate cuts and weakening of the US dollar. Finally, let's just jump onto the outlook in terms of the Nasdaq. So here's the Nasdaq. From a sort of wider perspective, we can see, of course, very long-term, strong bullish trend. Now, the daily time frame here, I've added a Donchian channel, which essentially is just sort of rather mechanical way of tracking swing highs and swing lows. I mean, better in my mind to utilize price action and horizontal levels, but nonetheless, this is a kind of quick and easy way to give you a good idea of what the trend is. And so, yes, we've pulled back of late. This is the daily time frame, remember. We've pulled back of late, But we're still within this bullish trend. As you can see here, we've got this swing low that's established down here. There we go. 22669. So if we break that level, then it starts to look like we're potentially going to roll over. Until that happens, you'd be saying, okay, let's see, is this a sort of fib? Let's get rid of that channel. We can get rid of it. There we go. And then look at this from a fib perspective and say, okay, is this come into a notable fib retracement and started to turn higher? Yeah, it has. Absolutely perfect on the nose. 76.4 fib. We rally, create a higher low, rally, break up through that swing high. And now we've been retracing somewhat. This to me looks like a short-term retracement within a bullish resurgence following a pullback into Fibonacci support. So I'm bullish for the Nasdaq. I do expect this bull market to continue. Certainly if we see inflation coming in weak, then that provides the basis for further upside here for these tech names. But the flip side, of course, if we see a sharp spike in terms of inflation pressures, we're likely to see this market move towards the downside in the near term. But like I said, really, you follow these trends. And so these key levels that you're marking along the way need to break before the theory that you have in mind is over. And that theory for me is that this bull market still remains in play unless we break the 22669. We've rebounded from the Fibonacci. We've consolidated a bit. I think soon enough we see the bulls back into play to try and push it back towards that 24,000 mark. I hope that's been useful for you guys. Make sure to like, subscribe and follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.